Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, March 12th, 2025. Today's episode begins with our headline, Dead Cat Bounce. S&P still looks weak to me. You really don't need a single technical indicator to see that this is a drop, and today's bounce of 0.5%, to anyone's normal eye, looks like a dead cat bounce. I'm thinking at this point, it looks like we may be headed down to this previous trend line that we had developing from April of 2024 to the bottom of August 2024. I expect sort of to get a bigger bounce here. Another area that has a lot of support below this area that Gareth Soloway brought up on his show is very interesting to me, and I wanted to share it. This blue line going sideways marks the exact top of 2021 before that major bear market throughout 2022. And then this green line represents connecting the exact bottom of the COVID crash low to the exact bottom of the 2022 bear market, connecting over here to this top line. Whenever you have two lines that cross each other, this is a major point. Everybody's eyes will see this, even if you're not a professional chartist and you just look at charts casually. That's why these areas tend to attract a lot of eyes, because you can see it without drawing the lines. You can, when and if the market gets down here, we can see, oh, look, there's a major pivot point there, and we can also see, hey, look, that looks like, yeah, it's a spot. When you have crossing major lines like this, my understanding is that it doesn't just act as an area of support, but it can actually attract the market down to that area. It looks like Mr. Market to me is likely to head down here. And then from this point, I think we may have a bounce, and then we could end up going actually quite a lot lower. I'm just going to restate my case that the S&P 500 does have the possibility of dropping in price by 80%. And I'm saying it a little nervously, but at the same time, understanding valuations, understanding that people expect returns from their investment. And when the S&P 500 is only offering a 1.3% dividend, and in history, it's actually really paid out, the owners of the S&P 500, 5% was like a normal amount for a while. Really, most of history before the 90s, you would expect a dividend yield much higher. And we're at historic lows today. Maybe I should bring up that chart. It's a chart I bring up on my macro show too, but I can't help talk about it today just to emphasize how far the market can really drop. This is from multpl.com, the S&P 500 dividend yield going back about 150 years. And like I said, before 1990, the lowest the dividend ever was maybe, around 3%. And, we had a range that we would bounce around on, normally anywhere between, what does it look like, 7% and 4%. Sometimes it spikes up when stocks get very unusually cheap. Very notably in the Great Financial Crisis, when everything was so bad, the dividend yield only rose to 3.24%. And this does have to do with corporate finance, money being reinvested into the company, and that's why it's important to look at earnings, not just the dividend yield. But I can't help imagine a scenario where Mr. Market wakes up one day and says, wait a minute, the S&P 500 is only paying me 1.34% return. And, while bonds or, money markets are yielding, whatever they're yielding at that point. If inflation continues higher and we get higher yields and they're yielding 8%, the S&P 500 just starts to look more and more ridiculous. If Mr. Market decides that, hey, you know what, I want, an 8% dividend on the S&P 500, well, that would be the equivalent of, the price going down, I think, over 80% from here. So, you know, bonds are supposed to be safe, by the way, and stocks are supposed to be risky. That's how they're designed. Stocks aren't supposed to always go up all the time. The fact that we've been sort of tricked into thinking that, stocks are always a safe investment, for the past several decades, I think is very frightening. It's the best way I can describe it. When you had the crash of 1929 and people didn't recover their money for 30 years, for being invested in stocks, it's just like, I don't know. This whole thing looks like a giant time bomb to me. Again, watch my macro show to hear the details on all of the macro views put together. I digress. I want to stick to the regular main show, so let's get back to it. I wanted to just add today, again, the advanced decline line continuing lower while the S&P 500 bounces here, and so that sort of adds to the confirmation that today's little bullish action of 0.5% up in the S&P 500 really is looking like nothing more than a dead cat bounce. I mean, we do have the VIX cooling off a little bit. I mean, it went down, but as you can see here, this number here is the closing number. It's still at 24. So yeah, it's no longer going exactly straight up anymore. And yet the market is still, ringing the alarm bell, full fear mode. The VIX futures curve fully inverted. So we're not out of the woods yet. I highly suspect that there's more downside to come in the S&P 500. Next on today's agenda, the CPI data came out a little bit weaker than expected. I mean, lower than expected. I mean, that's, Mr. Market's been hoping for lower CPI because, it means lower rates. It means more candy for the market. This is probably a good time to bring up the community topic, the inflation down and yields up question. How come inflation is down and yields went up a little bit? I think it has mostly to do with the fact that the CPI report didn't really shock markets. It was lower than expected, but not so much lower to affect things greatly. Again, it seems like Mr. Market cares more about what's may or may not be happening in the tariff world. But also, in general, you take a look at the 10-year Treasury note yield, and if you zoom out a little bit, this is certainly not looking like we're climbing higher and higher and higher. We're still well within sort of this downward looking channel to me. I mean, it's possible the bond market as well may have been looking for an even lower number in the CPI data. And of course, we're also waiting for the PPI, and the PPI is the one that sort of leads the CPI. The CPI is more lagging than the PPI. The PPI is a little bit more leading, and we get that data tomorrow. So the CPI data, by the way, if you haven't seen it for today, it came out a little. This is the expected column. This is the actual. So month over month, instead of the expected 0.3, it was 0.2. Year over year, instead of 2.9, it was 2.8. And then the core, same thing, 3 to 2. And then expected 3.2 to 3.1. So just a little bit lower than what Mr. Market was expecting. All right, so we covered tomorrow. PPI is coming out. And then the second community topic today, someone asked about Nissan stock. In a nutshell, why do I have 5% of my portfolio in Nissan? I do explain this, I think, in my portfolio update, but I don't mind reviewing it right now, especially because there is a little bit of an update in the company. So first of all, I'm invested in this stock because when I look at the current assets, plus you take the equipment and the land and you put a discount on it, if you were to liquidate the entire company and then pay off all of the debt, the stockholders would still get way more money than what the stock price is right now. And that's why this is considered to me to be a bargain deal by how it's defined by Benjamin Graham back in Security Analysis from the 1940s. It's important to understand the weight of those things. You know, when a company that exists, it's owned by the stockholders. When you own the stock, you own the company. And if it's liquidated, like I'm saying, you shut it down, sell everything, the stockholders usually get wiped out, because usually that means bankruptcy. So companies typically won't liquidate if, you know, if their balance sheet is okay, because why would they, when they still have a possibility of doing better business in the future? Unfortunately, you know, that's what can end up happening to a company like Nissan in the future, is if they continue to, you know, not have as good sales, and then the balance sheet starts looking weaker. You know, that's why stockholders typically don't get anything. But the fact is that right now, as it stands, the stockholders will be paid an enormous amount of money compared to the current price of the stock. And that's why that seems like an incredible deal to me. Now, just one update on Nissan stock. You know, if you're following it all, there was a lot of discussion over a merger between Honda and Nissan. And actually, Nissan stock really popped up on this news. Any kind of merger or acquisition news is good news, because there's a change and things might get better, basically, in a nutshell. It's how markets have always treated these types of events. And it seems like this merger, you know, didn't work out, and you know, and it's really unfortunate. It sounds like the CEO probably pushed a little too hard, tried to get a little too much for Nissan, and instead of being smart about it. I mean, if I was in charge of the whole thing, I'd liquidate it. Sorry to say, Mr. Monopoly here with his pet dragon. I would liquidate the entire company if I owned the whole company. I only own, you know, a small amount of shares, so I don't have enough weight. I don't have enough say in the company to do that. But I would liquidate the entire thing, and get my profits. I I'd get a return, because there would be a lot of money left over for the stockholders. So in a nutshell, the CEO ended up getting fired, I think a week ago or so. And so that development to me is a positive sign. And that tells me that the board members are not the only ones that, you know, see that, yeah, this is a problem if we can't figure out a solution. The CEO is coming out, you know, for a while saying, "Oh, we don't know if we're going to survive another year. All our sales are down. Everything's terrible." And then he won't merge with Honda. Like, come on, man. Like, just those. You don't even need to dig any deeper than that. You don't even need to know anything further than that to know that this CEO really messed up. And then he gets fired by the board. Good. Good riddance. Let's see how this company progresses from here. I mean, heck, maybe they'll do Mr. Monopoly's plan with me and my pet dragon and liquidate the whole thing, and we'll get paid. I'd be fine with that. Before we get through the rest of the charts, thanks for watching. Make sure to subscribe. I want to get to 1,000 subscribers. That's sort of my goal right now. I'm getting like a lot of my videos getting 500 views like on a regular basis. So I know a lot of people that are watching my videos aren't subscribers yet. So please subscribe. Also, thank you for all the support. I've been getting an enormous amount of support from the community. Really appreciate it. As always, if you want to hear me explain my daily reminders, watch Macro Update 21125. And watch Portfolio Update 21125 to hear my crystal ball ratings and my portfolio. On to the charts. Starting today, we already covered the S&P 500 and the VIX and all that. We're going to start the rest of the charts with copper. I don't have a whole lot of charts today. Overall, market seemed kind of boring, to be perfectly honest. But I do note that copper made a new closing high, which is normally sort of a bullish stance. Very, very interesting that we have the U.S. stock market falling apart at the same time as copper actually getting a bid. Again, yeah, the Copper doesn't see weakness in copper. I mean, you know, if things really do fall apart, we're going to need copper. There'll probably be there's likely to be government investment that involves copper, and this always, you know, any kind of infrastructure, that kind of thing, involves a lot of copper. You know, what surprises me is I don't see like automobile and housing markets getting very strong here, along with like commercial real estate. I mean, everything seems to be shutting down. Um, so yeah, I'm surprised. Dr. Copper is surprising me, and yeah, he's not someone to ignore. So I would expect I expect copper to cool off in price in the near future, but that's just me and my crystal ball. Next chart, I want to bring up junk bond credit spreads continuing to widen. Again, this is day old information and it updates in the morning for the last day. Spreading now to 3.22, just still continuing to go straight up. And then the last chart of the day I wanted to bring up was the break-even inflation rate. On CPI's data today, we actually did have a little bit of an uptick. Previously, this looked like it was, it was going straight down. It looks like it was gaining momentum to the downside. So we have a little bounce here. Could be a dead cat bounce. The PPI data should definitely affect things. And also as we get more updates, what's going on with the tariffs and how Mr. Market and yields and everything going on in the world economically, politically, all these things affect markets. So we'll see how it all pans out. That's all I have for today, and that's all from me, my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Don't forget to hit the subscribe button. I won't say that. I'll try do my best to not say hit the subscribe button as much as I can. I want to get to that 1,000 subscriber marker. As soon as I get there, I'm likely to not ever say that again. But for now, I want that's a goal of mine on this channel. So please subscribe. And that's all. Thank you. Goodbye. Robschild.